shared some data around the concentration of billion unicorns versus actual like return.
Multiple returners. Yeah.
Articulate that for me to kind of support.
So here's the thing. A lot of mega funds or a lot of emerging managers get mad at the mega funds because they go, by simple math, emerging managers should outperform the biggest funds because it is easier on a dollars basis to hit 3, 4, 5x your money if you're only investing 50 million than if you're investing 500 or 5 billion. And they're right about that. That's math. And like, it definitely is true. What they miss is the mega funds are not doing this on the same level playing field that they are, and they're not promising their LPs the same thing. They're not saying we're going to 5x your money. They're saying you're going to be in the most generational, well talked about names before they go public, and we're going to get you there, and you might 2x your money. And guess what? If you have $2 billion, 2x is pretty good. Capital preservation matters as much as capital accumulation at that stage. Now, for the advice that I would give emerging managers is, if you can find the right companies at the very early stage, they can become 25, 50, 100 times more valuable and still not really make a blip on the mega fund radar. The real big question is, and that's awesome, that strategy's been around for a while. The big question is, how do they exit? Way too many, I don't think angels in particular or small funds spend enough time thinking about how does this company exit? To whom? Because you are not IPOing at $1 billion. So if you would like an exit, you need an acquisition, or you need to take secondary out along the way. And like angels getting a lot smarter about who these companies exit to and can they be helpful in that? And then if not, can you take secondary out along the way? I think there's massive tailwinds to angels and small funds over the next, call it 10 years.
So give me Peter's version of what's your exit strategy, because that's a question that kind of easily gets thrown out. A lot of entrepreneurs kind of recoil against. They're like, okay, it sort of is it has baggage around it.
Totally.
How would you ask that or double click into that more thoughtfully, given how important it is based on what you just shared?
Great question. So if I'm interviewing a founder, the answer that I want to hear, and this is an angel investment, right? Like this is a very early founder, probably a first time founder. They're like, who knows what they've thought. So there's some grace to be given in these answers. But what I'm looking for is the following. Do you understand at minimum the structure of the industry you're entering? Who are the major players? How does the value chain work? Okay. Secondly, if I ask you, hey, in 5 years, your business has done pretty well, but not great. Who are your potential acquirers? You should have 3 names off the bat. And you should have clear reasons why they would be acquired. And then I make the investment, a couple years pass, et cetera. As an angel, what am I going to do? Have you made relationships with those people? Companies do not get acquired when they have a 6-month sales process and they go and shake hands with people for the first time. If you're going to get bought, the people who are going to buy you should know you for years before they buy you. That is the vast majority of good acquisitions in startups. So like put your money where your mouth is. Like go and make the relationships. Some of them might be competitors. Some of them are weird strategic co-opetition people. Like, I think for some industries, it's very easy. Medical devices, it's very simple. There are very few independent medical device companies that don't end up getting purchased by major strategics, healthcare insurers, et cetera. And so like those people, the pathway is very clear. For software, I think there's been this, it's almost like a willful ignorance of it because the goal is IPO and that's the only goal. I just think that it's in this world, it's kind of silly to assume that you're going to be there. Maybe assume it, but have some backup plans along the way.
Yeah. What's your actual plan for delivering on this thing you told me when you pitched me to?
Totally. Yeah.
A quick note before we continue the conversation. Alongside the Diligent Observer podcast and newsletter, I also run an outsourced operations service specifically built to serve angel networks. My team handles things like initial screening, social media, newsletter prep, platform management, and a whole lot more. The kinds of things that either aren't getting done or shouldn't be done by busy community leaders. If that sounds interesting to you, send me a note. As you may have noticed, we are recording this conversation live from the Angel Capital Association Annual Summit. Now, if you're not familiar with the ACA, this is the world's largest professional organization specifically designed for angel investors. So if you're serious about this ecosystem or just generally interested in learning more, the ACA's education, resources, and community are definitely worth checking out. You can go to angelcapitalassociation.org. And I gotta say, this is our second year live recording in the room, and I had an absolute blast. Cannot wait to come back for future years, and I hope to see you there.
Okay, so Peter, we have to talk about safes.
Yeah, we do.
We have to.
Okay.
We have to. Tell me about angels and safes.
All right. So whenever I talk to groups of angels, which I do less these days than I used to,
You're brave for being
they always give me so much for the safe stuff. And it's like two things I want to make clear. One, I did not write the safe. I am not like saying that the safe is the best instrument in the world, nor am I saying that it is right for every investment. All I'm saying it is the default. If you are ignoring safes, you are by definition ignoring a segment of the market that uses them.
How much of the market? Like
massive amounts of the market. In every single state that we operate in, which is all 50 states in the country, the majority of capital that flows to pre-seed companies goes through safes.
And you guys have how many of those?
60,000 startups. So the good folks at ACA have a fantastic report about the angel funding report that aggregates, I think, data from 1,300 companies. And there are many of them. I was talking with Rick about this the other day, or just now. Almost none of them have taken safes in some of those parts of the report. I'm just telling you that's not what's happening on the ground where angels are most plentiful, which is New York, California, Seattle, Dallas, San Francisco, et cetera, et cetera, et cetera. Safes are here to stay. Now, there are things you can do to make safes better. First one, which I heard in there today, add a side button. Definitely add a side button. You're looking for information rights. You're looking for most favored nation status on the safe. Maybe you're looking for pro rata or pro rata plus. Awesome. Great way to improve safes for you. Second, if you're an angel, your safe should have a conversion mechanism that is not simply a qualified financing. I can't tell you the number of times that I know angels who said, I gave this company $20,000. They ended up becoming kind of a lifestyle business. They're not going to raise venture. And so my safe doesn't convert. It just sits there. So those are two easy ways to make the safe a better instrument. I get why people are annoyed by it. It's a little bit like, get with the times. This is happening everywhere.
Thanks for listening to this episode of The Diligent Observer. I'm your host, Andrew, and if you're an angel investor looking for essential angel intel in 5 minutes every week, I think you'd enjoy my newsletter. I send my best stuff, interesting deals, and more straight to your inbox so you never miss a thing. Subscribe today at thediligentobserver.com.